Ladies and gentlemen, friends of the channel, thank you for joining me today. If you'll indulge me for a moment, imagine this: the global financial machine humming along, credit flows expanding, currencies assumed stable, and then, quietly, the foundations begin to shift. The debt load becomes an anchor. The money created today becomes tomorrow's liability. In that subtle transition lies a crisis in motion. That's what we're seeing now in the silver market, and why the true value of gold is rising into plain view. When you look at what's happening in the world today, you have to step back far enough to see the long arc of history, because none of this is new. The structure we're living in, the monetary system, the credit system, the way governments fund themselves, all of it runs in cycles. Those cycles repeat because human behavior repeats, and right now, we're at a point where the cycle is shifting in a meaningful way. When debt loads become too large relative to income, when governments must choose between defaulting or printing, and when the value of money becomes increasingly dependent on confidence rather than fundamentals, you begin to enter a phase where the entire financial order transitions. That's the environment we're in. We've created enormous amounts of debt globally. That debt didn't come out of thin air. It was encouraged because low interest rates made borrowing seem harmless. Governments borrowed, corporations borrowed, consumers borrowed, and each borrowing cycle pushed asset prices higher because money was cheap and abundant. But cheap money is never free. It distorts reality. It creates the illusion of growth because everything looks like it's rising, when in fact it's being inflated by credit. Eventually, you reach a point where the credit expansion cannot continue without causing instability. At this stage of the long-term debt cycle, policymakers face a dilemma. If they raise interest rates to fight inflation, they risk breaking the debt structure because the borrowers cannot handle the higher cost. If they keep interest rates low, they allow inflation to rise and the value of money to fall. Both choices have consequences. That dilemma is precisely where the world's major economies are stuck. And every time in history that this has happened, in the 1930s, the 1970s, even in ancient economies, the outcome has always been the same: a restructuring of money. This restructuring isn't just a technical shift. It changes how people behave, how they save, and how they perceive value. When trust in currency weakens, people instinctively search for alternatives. They look for assets that cannot be printed, that do not rely on somebody else's promise to pay, and that retain purchasing power across cycles. This is why gold and silver come back into focus, not because of hype, but because they represent the opposite of what fiat currencies have become. But before even getting into gold and silver, you have to understand the backdrop. The global system is moving from a period of effortless money creation into a period where every new dollar printed reduces the credibility of the system. You can already see the signs. Inflation isn't transitory. Debt service is becoming heavier. Government spending is growing faster than economic output. Major countries are quietly shifting reserves away from currencies that are increasingly unstable. This is not random noise. It's the classic ingredients of a monetary turning point. At times like this, people look at markets and try to understand why things feel unstable. They see volatility in bonds, currencies swinging, commodity prices behaving erratically. But what they're actually seeing isn't volatility. It's the system trying to find a new equilibrium. When the foundation of money shifts, everything built on top of it shifts as well. And that's why you cannot analyze today's environment with the assumptions of the last decade. You have to think structurally. You have to recognize that markets move not only because of economic forces, but because of political decisions, societal pressures, and global power dynamics. This is also why the conversation about precious metals is resurfacing with urgency. It's not about short-term price moves. It's about understanding what happens to real stores of value when a monetary cycle is ending. Every time currencies weaken, real money becomes more important. Every time debt burdens become unsustainable, assets that sit outside the credit system become essential. And every time trust declines, people return to the things that cannot be manipulated. So when you hear the term structural turning point, it's not a slogan. It's the reality of where we are. Money, debt, credit, confidence, all of these are interlinked. And when one breaks, they all begin to shift. We're living through one of those shifts now. And to navigate it successfully, you need to understand not just what is happening, but why it is happening. Because once you see the pattern, the emerging landscape becomes much clearer. When you study markets over long periods, you start to recognize that crises rarely appear out of nowhere. They build silently, accumulating pressure in places most people aren't looking. Silver is a perfect example of that dynamic right now. For years, its price behavior has been misunderstood because people tend to view it through a narrow lens, either as an industrial metal or as a cheaper version of gold. But silver doesn't fit neatly into either category anymore, and that's precisely why it's now facing a critical moment. What looks like a simple commodity fluctuation is actually a deeper structural shift that reflects changes in the global economy, the supply chain, and the monetary system itself. The first piece of the puzzle is supply. Silver production has quietly been under stress for a long time. Unlike gold, which is mined in projects specifically designed for gold extraction, most silver comes as a byproduct of other mining operations, primarily copper, lead, and zinc. This makes silver vulnerable to disruptions that have nothing to do with silver's own fundamentals. When base metal mining slows because of declining margins, regulatory pressures, or energy costs, silver production automatically drops. That's exactly what's happening. We've seen tightening environmental rules, rising operational expenses, and geopolitical risks in key mining regions. All of these reduce output, but few people pay attention because silver isn't the main target of those mines. Yet the downstream impact is significant. Then you combine that with the second pressure shifting industrial demand. Silver has always been crucial in electronics, medical applications, solar panels, and various high-tech components. But the world's industrial sectors are reorganizing. Manufacturing cycles are slowing in some regions, reshoring is accelerating in others, and energy transition technologies are uneven in their adoption. These shifts create a mismatch between the timing of demand and the availability of supply. When manufacturers suddenly increase orders due to a technological push, whether it's solar expansion or new electronics production, the supply chain cannot respond quickly because silver output doesn't ramp on demand. This creates structural tightness that slowly builds toward a tipping point. But the deeper issue is that silver's role as a quasi-monetary asset has been eroding for decades. Historically, silver acted as money for nations, banks, and individuals. It had a monetary identity and therefore a monetary premium. That premium has been fading because central banks no longer accumulate silver the way they accumulate gold. Governments do not anchor policies to it. Financial institutions don't treat it as a reserve asset. Without that monetary backbone, silver becomes overly dependent on industrial cycles, which makes it more volatile and more vulnerable. This transformation in identity is what pushes silver into its current crisis, a metal caught between its past as money and its present as an industrial commodity. And yet, the crisis isn't simply about supply and demand or the loss of monetary status. It's about what happens when the global financial system begins to show stress. When currencies weaken, debt expands too aggressively, or geopolitical tensions rise, investors start searching for hedges. Gold absorbs the bulk of that demand because it is still recognized universally as a store of value. Silver, by contrast, receives a smaller portion of that capital flow, and the result is erratic price behavior. It surges quickly during moments of fear, then falls sharply when industrial demand softens. Investors misread these movements as irrational volatility, but they're actually symptoms of an asset that has lost clarity in its purpose. This is why silver's crisis is not temporary, it's transitional. It reflects a world moving away from middle-tier monetary metals and consolidating around assets with the strongest historical credibility. At the same time, silver remains essential to modern technology, which means it cannot be dismissed. It's trapped in a dual identity, too industrial to be a pure store of value, yet too scarce and too historically relevant to be treated like any other industrial metal. When an asset is caught between two roles, it eventually gets repriced, and we're entering the phase where that repricing becomes unavoidable. Most people won't notice the change until it becomes extreme, because crises often progress in slow, invisible stages before becoming obvious. But the signs are already present: tightening supply chains, periods of chronic deficits, inconsistent industrial cycles, and sharp price swings during monetary stress. These are classic markers of an asset approaching a structural inflection point. Understanding this allows you to see what others miss. Silver's crisis isn't a headline, it's the unfolding of long-term forces that have been converging for years. To navigate it, you need to see the underlying dynamics, not the day-to-day noise. When you think about assets that survive the tests of time, you inevitably come back to the same principle that has guided human societies for thousands of years: trust. Not the emotional kind, but the structural kind, the kind that forms the backbone of any functioning monetary system. When trust in money weakens, everything built on top of that money weakens with it. That's why gold has maintained a place in global portfolios, central bank reserves, and personal savings across every major era. It represents something that fiat currencies, credit instruments, and political promises cannot replicate: permanence. Gold's value isn't defined by yield, productivity, or innovation. It doesn't change with the pace of technology. It doesn't depend on a corporation's earnings or a government's fiscal discipline. Its power comes from the fact that it stands outside the system. It cannot be printed, it cannot be devalued by policy choice, and it isn't someone else's liability. That single characteristic, that it doesn't rely on the promise of repayment, is what makes it uniquely stable when the rest of the financial world becomes unstable. To understand why gold matters today, you have to understand what a store of value truly is. It's not just something that appreciates. A good store of value maintains purchasing power across cycles, across regimes, across crises. It holds steady when currencies falter, when debt burdens break balance sheets, and when political decisions distort economic reality. Throughout history, whenever nations overextended themselves, when they printed too much money or allowed their debts to exceed their income, their currencies eventually lost purchasing power. And in every one of those cases, gold emerged as the asset people turned to. There's a simple reason for that. Gold is the anchor in a world of moving parts. Everything else, stocks, bonds, real estate, currencies, is tied to conditions. They depend on growth, cash flows, monetary policy, or credit availability. Gold doesn't. That independence is what gives it a unique strategic importance, especially in periods like the one we're living through, where the reliability of money itself is in question. When central banks accumulate gold, they're not doing it because they expect explosive returns. They're doing it because gold provides them with an asset that cannot be devalued by another nation's monetary decisions. It's a geopolitical hedge as much as an economic one. It is neutral, globally recognized, and universally liquid. Even today, with all the technological innovation and financial engineering the world has created, gold remains the only asset that every country trusts in times of uncertainty. But gold's significance goes beyond central banks. For individual investors, its role is equally important. Most people think of investing as maximizing returns, but that's not the full picture. Real investing is about balancing risk. It's about ensuring that you preserve purchasing power under different future scenarios, not just the optimistic ones. Gold shines in the scenarios where paper assets stumble: high inflation, currency devaluation, slow growth, geopolitical conflict, and major debt restructuring. These environments may not occur often, but when they do, they reshape the entire financial landscape. In those moments, the question isn't how much you made, it's how much you kept. Another point often misunderstood is that gold doesn't need to outperform other assets all the time to be valuable. Its power lies in diversification. When portfolios are built solely on the assumptions of growth, stable money, and predictable policy, they're fragile. Gold provides balance. It performs differently enough from financial assets that it reduces portfolio risk in a way very few other assets can. It's not about excitement, it's about resilience. You also have to consider the psychological dimension. In uncertain times, people instinctively fall back on what they believe is real. Paper money loses meaning when it can be created in unlimited quantities. Bonds lose reliability when governments are drowning in debt. Even equities lose clarity when earnings become unpredictable. But gold maintains its identity regardless of the environment. It gives people a sense of continuity when everything else is changing. What makes today particularly important is that we're in a period of declining trust in currencies, trust in fiscal responsibility, trust in political stability, trust in the future predictability of markets. Gold becomes more relevant in such periods not because it's fashionable, but because it functions as a hedge against the very issues that are rising. It is a counterweight to uncertainty. That's why understanding gold's true value matters. It's not a speculative asset. It's not a trade. It's the store of value that has lasted through every major monetary shift in history. And as the world faces another transition, one defined by debt pressure, inflation risk, and geopolitical fragmentation, gold once again becomes the anchor that helps investors weather whatever comes next. When you navigate an environment shaped by rising debt burdens, shifting monetary policies, and weakening currency credibility, the most important principle is not prediction, it's preparation. People spend enormous amounts of time trying to guess what the next move in markets will be, but the truth is that nobody consistently predicts the future with accuracy. What you can do, however, is build a strategy that can survive a wide range of possible outcomes. That is the essence of smart investing, and it becomes even more essential during periods when the financial system is transitioning, like the one we're living through now. The idea of hedging and diversification isn't about spreading money randomly. It's about recognizing that the world is too complex and too interconnected for any single asset, policy, or assumption to carry you safely through all conditions. Every asset has strengths and weaknesses. Stocks thrive in periods of growth, rising productivity, and sound monetary environments. Bonds perform well when inflation is low and interest rates decline. Real estate prospers when credit is cheap and incomes are stable. But every one of these assets struggles under certain conditions that are becoming more likely as debt cycles advance, monetary credibility erodes, and geopolitical tensions rise. That's where the strategic role of gold, and to an extent silver, becomes relevant. Precious metals are not meant to replace your portfolio. They are meant to balance it. When you hold gold, you're not betting on fear. You're acknowledging that the financial system, like all systems, is vulnerable. Historically, gold performs well in the scenarios where traditional assets struggle. High inflation, currency devaluation, debt restructuring, limited trust in institutions, or conflict-driven shocks. These aren't everyday occurrences, but when they do happen, they reshape everything. And if your portfolio isn't prepared for those moments, the losses can set you back years, sometimes decades. The key is understanding proportions. A strategic hedge is not an all-in approach. It's about holding enough of an asset so that if the world moves in an unexpected direction, the hedge meaningfully offsets damage elsewhere. That's what stability looks like. Gold doesn't need to dominate your portfolio, it just needs to be there in a meaningful share. Historically, a moderate allocation has been enough to protect investors during inflationary periods, monetary resets, or debt crises. And when you combine that with a diversified exposure to equities, bonds, and real assets, you create something incredibly valuable: resilience. Another aspect people underestimate is optionality. A well-structured portfolio gives you the ability to take action when opportunities emerge. If all your assets are highly correlated and everything falls together, you're forced into a defensive posture, usually at the worst possible time. But if you own assets that behave differently, you have flexibility. You can rebalance. You can take advantage of price deviations. You can buy when others are panicking because you have something in your portfolio that held its ground. This is the quiet, overlooked advantage of proper hedging. You also have to consider that the world ahead is likely to be more volatile than the one behind us. Governments are carrying record debt burdens. Central banks are constrained by rising inflation risks. Political polarization is increasing globally. Geopolitical alliances are shifting. Supply chains are being rewired. These are not normal conditions, and in such an environment, single direction bets become dangerous. The era where you could simply hold stocks and expect smooth, compounding returns is being replaced by one where cycles are faster, corrections sharper, and policy decisions more unpredictable. That's why you don't manage portfolios based on hope. You manage them based on probabilities and historical patterns. And history shows very clearly that during major transitions, those who held diversified, balanced portfolios preserved wealth, while those who were concentrated in any single asset class suffered heavy losses. You don't need faith or emotion to understand this. It's a pattern that has repeated across centuries, across empires, across monetary systems. This is also why relying purely on fiat currency savings is risky. Cash loses value in inflationary environments. Bonds lose value when interest rates rise or when the issuer's debt becomes unsustainable, and equities lose value when earnings decline or when liquidity dries up. In such an environment, real assets, including precious metals, provide a counterweight, not because they're perfect, but because they're structurally different. A sound investor doesn't try to guess which asset will win. A sound investor builds a portfolio that can withstand whatever reality emerges. And in a world of rising uncertainty, that means balancing financial assets with tangible stores of value, maintaining liquidity, embracing diversification, and recognizing that preservation matters just as much as growth. The purpose of strategy isn't to be right, it's to survive long enough to benefit from the opportunities that come after the storm. That's what a resilient portfolio gives you. And in times like these, resilience is the most valuable asset you can own. In closing, we stand at a crossroads. The old paradigm, unlimited credit, stable currencies, linear growth, is increasingly questionable. The silver crisis is a warning light. The true value of gold is the reassurance in a shifting world. My hope is that you will think of gold not as a gamble, but as a strategic decision, a decision to hold something real when many things turn uncertain.